oriented around proactive care, our view is that carries immense potential to further drive acquisition efficiency. What we observe on the LTV front is that as we are able to help our providers on the platform pair consumers with personalized treatments that really are unique and meet their needs, that effectively drives stronger retention across the platform, whether that's, as we talked about in the prepared remarks, addressing multiple conditions through more simple mechanisms or helping users balance both efficacy with side effects or providing alternative form factors. We see all of those things as well as the ability to leverage more and more insights to help providers pair consumers with those treatments, driving stronger retention, which ultimately drives stronger lifetime value for the consumer.
That's very helpful. Thanks very much.
Your next question comes from the line of Justin Patterson with KeyBanc Capital Markets. Please go ahead.
Great. Thank you. Good afternoon. I wanted to talk a little bit more about some of the investments you're making. It sounds like between AI, labs, and wearables, you're creating the conditions for a flywheel down the road. So I'd love to hear a little bit more about just how deep you're looking to go into the wearables ecosystem, how long we should really think about the investments to support some of these initiatives, and how we should think about labs, the steps to scale up labs over the next year or so. Thank you.
Yeah, thanks, Justin. I think those three buckets are a real focus for the business. And I think when you step back, there's just never been an easier way to collect more advanced data from patients across these things, whether it's wearable devices, whether it's polygenic risk scores that you can do a swab on the inside of your mouth, whether it's cancer testing or it's full gene sequencing. It's just really incredible. And so as that accelerates and our investments in YourBio accelerate and we're able to get testing at home for cheaper costs, we'll be verticalizing that infrastructure so that you, as a member of Hims & Hers, can be getting access to this type of data collection on a really frequent basis. I think that intelligence layer to then help understand how we get ahead of what you are struggling with or what you may struggle with in the future is going to be an increasingly important part of the business. And so this is where I think the platform really transitions from focusing on a single treatment to proactive preventative care. I actually think that type of care is in and of itself a new category for Hims & Hers. It's almost a longevity category, so to speak. But I think as people start to realize a platform like Hims & Hers gives you access to what the 1% have and lets you take the necessary steps to get ahead of it, it's extremely empowering, right? And so we are going to go deep in all three of those areas. From the device side, either through our own or through partnership. We've obviously already acquired our own blood testing device, through our own AI efforts and teams, which we've already started to launch with the labs efforts. And it's starting to pay off, right? When you look at the prepared remarks, we shared that 70% of people who do a lab test on the Hims & Hers platform identify an area of risk that is treatable on the Hims & Hers platform. Right. Most of the time, this is something patients are learning for the first time, that they're pre-diabetic, that they're at risk of cardiovascular disease, et cetera. And so there's a massive flywheel in making the entry point in data collection and learning about your health extremely low and extremely easy to get started, and then ultimately build value over the long term with these patients as we expand our care and can have a more comprehensive look at their health.
Yeah, I think what I'd add to that, Justin, is I think similar to what we've done in the past, like we will be thoughtful and continue to stage gate the investment. I think much of what we're investing in kind of follows the four pillars that we've always spoken around, which is like the brand, the investment in technology and data that reinforces the personalization and unique products we're able to deliver, as well as just the strength of our provider network. And so I think that what you see now is a very vast balance sheet as well as a strong free cash flow that's enabling us to make the transition that Andrew mentioned towards a platform that is more oriented around leveraging data to treat consumers proactively. Ultimately, we think that these investments, as they start to come together in 2026, in outer years, have the ability to quickly have positive ROI and ultimately pay off for themselves and become self-funding, whether that's in the form of higher lifetime value that we discussed around the last question, or even just with proactive care, being able to unlock new insights to consumers to drive better acquisition efficiency through lower cost channels. Those are all mechanisms that we'll monitor and continue to lean into, that ultimately we believe have the ability to effectively make these investments pay for themselves very quickly.
Great. Thank you both.
Your next question comes from the line of Craig Hettenbach with Morgan Stanley. Please go ahead.
Yes, thank you. For some of the legacy core offerings, can you just talk about which categories you expect to kind of drive growth in 2026? And then within weight loss, is there a range that you're embedding into guidance for this year?
Yeah, thanks for the question, Craig. Like, maybe I'll start. I think increasing, like, just the concept of, just want to caution the concept of core, versus like non-core is becoming increasingly less and less relevant. I think that how we're orienting the business is because the lines across specialties are blending more and more, is really around the concept of international and domestic. And then underneath that, what you do see is you have businesses of varying tenure. We see, a lot of potential in both the Hims and Hers specialties, for continued growth. I think we were excited to see the Hims brand grow 30% year-over-year in 2025. And we do believe that we're positioned for continued growth, whether that's in the form of newer specialties like testosterone that are rapidly emerging, or even as we start to see the benefit from the stronger retention on the daily health offerings, in both sexual health and greater assortment in other categories like hair. Each of these disciplines have the ability, within the Hims specialty to continue to power growth. And then flipping to Hers, we're seeing, very much the same element. Historically, newer categories that we've launched have taken, 12 to 18 months to scale. I think that as we look at around things like labs, menopausal support, as well as some of the tenured categories like Hers hair, we continue to see robust growth across many of those, and I think we'll continue to invest in those. But as we make the transition that Andrew mentioned, previously in both his prepared remarks and in the question, we're able to proactively serve consumers. I think that's going to be a pretty substantial unlock that will provide the ability to, for us to continue to see our tenured specialties grow.
Got it. And then just as a follow-up, when I think through the 2030 target and kind of the path to 20% margin, you commented a few times international is kind of break even and there's some investments there. So is there anything around kind of the U.S. business or efficiencies that are helping to potentially offset some of the drag on international just from a margin perspective?
Yeah, I don't think that the drag on international is going to necessarily be, permanent per se. I think that what we will do, and I think it's almost going to be more on a market by market basis, we will, look at the opportunity, in front of us. I think across most international markets, the orientation will be a growth orientation. I don't know that the international universe necessarily will be static for us as well as we, continue to, utilize our current assets as well as the Eucalyptus team to launch in new markets. Newer markets will tend to probably carry a more challenging margin profile. But then as we, look to markets that season over the next 2 to 3 years where there's already a strong presence in, there's the opportunity, to start to see some margin expansion as you get 2, 3 years out. And you kind of, if you look at the history of the U.S. and as we made the transition from, a loss-making business on our domestic operations to profitability, the ramp in margin as we were able to realize economies of scale kind of, from 2022 to 2023 was fairly rapid. And so I think our expectation is on a market-by-market basis, there'll be a similar concept in the international markets. And then as we look to the domestic operations, we are investing, fairly aggressively in a number of newer tenured specialties. As those specialties hit their, milestones and stage gates, we'll continue to invest. But what you also do see is on a specialty-by-specialty basis, the spread between the tenured specialties and the newer specialties, the margin profiles start to converge. And so I think between that and the domestic operations, as well as on a market-by-market basis, international markets kind of in the latter half of this decade becoming more and more margin accretive, we view that as the path to hit our goals of $6 billion in revenue and $1.3 billion of adjusted EBITDA.
Got it. Thank you.
Your next question comes from the line of Eric Percher with Nephron Research. Please go ahead.
Thank you. Andrew, I'd like to ask your perspective on the composition of the international business as we look out a year, both across Zava and Eucalyptus, in terms of the specialties or personalization? And then I know you had this line about becoming a leading provider of branded GLP-1 medications. Is that as simple as what we see running through Juniper today? And how do you think about maintaining relationships with the brand manufacturers?
Yeah, that's a great question, Eric. I think the composition overseas will likely mirror eventually as it matures the U.S., right? I think there's a lot of category expansion overseas, and each of these businesses that we are integrating in have different focuses in different markets, right? The Pilot brand in Australia, very focused on men. The Juniper brand focused on women and weight. Ultimately, we think that it will probably converge to have really nice diversity at scale. I think overseas, the relationships with our international teams and the branded pharmaceutical companies is quite strong because there's really consistency. They've got great rapport. They've been able to be a large consumer distributor to them. I would expect that to maintain and stay consistent. We don't expect to change that model. I think that's the winning model overseas, and would expect it to remain so.
Thank you. And just to follow up, was the comment on the majority of the business being non-weight loss, both for revenue, and was it free cash flow or cash flow?
Yeah. The comment was just around the majority of our revenues are actually coming from outside of the GLP-1 business, today. And then you can just translate that from, the tenured specialties carrying a more robust margin profile from economies of scale. The adjusted EBITDA or the margin profile tends to be stronger on mature categories as well.
Thank you.
Your next question comes from the line of Mark Mahaney with Evercore. Please go ahead.
Thank you. I just want to ask two questions about both the fertility opportunity that you're seeing and labs to date. You've talked about them both in the past. Can you just give us a more of an update on the data points that you're seeing and how you think about those opportunities? Thank you.
Yeah, thanks, Mark. We've yet to launch anything on the fertility space. We have launched in the last couple of months the menopause, perimenopause, and low T, as well as labs. Those kind of happen side by side. So far, I would say just, nearly 10 years of testing out go-to-market strategies, I would say we are incredibly encouraged by the early data. I think we believe that each of those three have near-term opportunities to scale to $100 million run rate, just like many of our other winning categories. We also see that the actual engagement with the experience from a consumer standpoint is a very high-value engagement. On the hormonal side, men are seeing massive increases in their testosterone levels, feeling better. Retention indications are showing it's in line with some of our best-in-class categories. And on the lab side, also, it's just providing people data that, frankly, used to cost somewhere between $5,000 or $10,000. And so it's an immense amount of knowledge. And then from there, 70% of those people are identifying an area of concern and an area of clinical risk that the platform can actually help treat. And so I think both in hormones and labs, we're incredibly encouraged. We've got dedicated efforts on both of those. And I'm fully convinced that they will be big parts of the business going forward and for the coming years.
Thank you very much.
Your next question comes from the line of Brian Tanquilut with Jefferies. Please go ahead.
Hey, good afternoon, guys. Maybe just a quick question, Yemi. As I think about the range of guidance on EBITDA, pretty wide range there where it could be down or up in the year. Just curious what the swing factors are that we should be considering that would drive the variability there. Thank you.
Yeah, I think it's a great question. I think a lot of it is, like we've historically done, in the past, we stage gate many of our investments where as they hit scale milestones or as they achieve unit economic profiles, we tend to lean in a bit more. As you look kind of at the end of 2025, we launched three specialties that we feel have the ability to be fairly transformative to the platform. And so I think what our guide provides is the ability and the flexibility to lean into continuing to scale those specialties if we see them achieve promising signs on the unit economic front. We spoke a little bit around how we're investing in tech and then some of the ROI that we expect to see there. Additionally, embedded in our guidance is the flexibility, to continue to proceed with many of those investments as they show signs of success. And then the final area of investment, that we spoke around really is just in the international business, both in terms of as we do the integration of the assets with some of the companies that we've already closed upon, such as Livewell, as well as Zava, but also, with Eucalyptus potentially coming in the second half. We wanted to leave ourselves a wide enough range to invest across all of those areas. And so if we see meaningful opportunities for growth in technology, meaningful growth opportunities in new specialties, or meaningful growth opportunities in international markets, we definitely want to take the growth orientation to take them, because we feel like, as we've demonstrated in the past and from past pattern recognition, the ability to expand margins with greater scale is something that our teams are quite good at.
Got it. Awesome. Thank you.
Your next question comes from the line of Glenn Santangelo with Barclays. Please go ahead.
Yeah, thanks for taking my question. Hey, I just want to follow up on the 4Q U.S. revenue number being up 17%. I was kind of curious, if we were to sort of parse out the compounded GLP-1 revenue, would the compounded GLP-1s a headwind or a tailwind to that number? And the reason I ask, right, is because, Andrew, you're sort of talking about, that it's becoming such a small part of the subscriber base, but yet, Yemi, you sort of talk about it as a $65 million headwind in 1Q. I'm just trying to reconcile all those data points and how we should think about, the contribution at this point, particularly within the fiscal 26 guidance. Thank you.
Yeah, well, I think maybe I'll start with that. I think what you do see, kind of in the transition from Q4, and then I think you'll really see this in Q1, is just we have a shift to where we are recognizing a lower revenue per order. That's not just a shift on new customers. I think it's a shift across the entire business that's progressively happened over the course of the last, call it 2 to 3 quarters. The ticket size for the GLP-1 business, is a bit larger, than our core business. So the revenue impact as well as the EBITDA impact, there that we see, is fairly meaningful. But I think that said, I think while GLP-1s have been a meaningful growth factor to the platform over the course of the last year, as we kind of stated in the prepared remarks, the vast majority of the revenue is made from the non-GLP-1 business. And as we continue to diversify, we expect that trend to continue. And Andrew, not sure if there's anything you wanted to add more broadly.
Nope, I think that's right. Thanks, Yemi.
Okay, thanks.
Your next question comes from the line of Ryan MacDonald with Needham & Company. Please go ahead.
Hi, thanks for taking my questions. Andrew, obviously a lot of news flow sort of post the pill launch and then sort of pulling the pill from the market. Can you just give us an update in terms of sort of where sort of things stand from a regulatory perspective, if you've had any conversations with FDA or DOJ, or sort of what level of concern, I guess, there is around that? And then the second question I have is around clarification on your earlier response. I think it was to the first question. You talked about that obviously the pipeline is very strong for at least a dozen or 2 dozen treatments in the next couple of years here. As you think about supporting that broadening assortment, do you intend to do so via branded partnerships as those come to market, or sort of continuing sort of the historical practice within the business of focusing on personalized offerings instead? Thanks.
Yeah, Brian, it's a great question. On the pill side, as well as the others, there's probably not too much we can say. I think we believe that the pill was a continuation of the strategy to broaden greater personalized options for patients on the platform, and spend many months working on that. I think we pulled it back to prioritize, honestly, just engagement and the relationships with the ecosystem stakeholders. We talked to quite a few of them on launch, and understood their dynamics and chose to prioritize them in those conversations, and so decided to pull it. Regarding FDA and DOJ, I don't think we can share too much on anything ongoing, but continue to welcome their conversations, and as we've talked about within the FDA in the past, feel very strongly that they play an important role in the safety of consumers, and so are happy to be working with them to figure out the areas of concern. On the pipeline side, when you look at the weight loss category in specific, I think there's an accelerating amount of treatments that are going to be coming to market that are on the branded side of the business. So, this is next-gen biotech that are in phase 2 and phase 3. This is some of the larger players. And so I do think consumer sentiment and consumer demand is going to continuously change. You see that in the last few years from when these drugs first came to market with the launch of Zepbound vials. You see traffic dynamics moving pretty materially when you look under the hood. I think that's just going to be the evolution of this category where you're going to have more and more options. They're going to be at different price points. They're going to have different side effect profiles. They're going to be known by different providers. And ultimately, I think for us, as we've said across all of our categories, we've seen breadth really matter. And so I do think we'll continue to evolve our platform, evolve our relationships and our approach to make sure that, what we have on the platform is what people want. I don't think we are stuck in any single way. I think we have prioritized the consumer up until this point for what we think is best for them and what they are looking for and what they want. And as that changes, we'll continue to change with them.
That concludes the question and answer session. Ladies and gentlemen, this concludes the Hims & Hers fourth quarter 2025 earnings call. Thank you all for joining. You may now disconnect.